Yeah, good morning, Alex. See, my sense is I think in most of the defense companies, it's very difficult to actually get a quarter on quarter kind of growth. Basically, the business for defense is lumpy. So, this kind of, performance which has come in the December quarter has been one of those quarters where execution has not been up to the mark. But that doesn't rule out the possibility that going forward with the kind of order book the company enjoys, the company will definitely do well. But yes, this quarter has been a big disappointment, and that is obviously getting reflected, by the stock price as of now. See, my sense is that if the investor can keep a investment time frame of at least 12 to 18 months, because this is one company which has got a very healthy order book in terms of drones, and technologically wise, its products are all approved and obviously are all ready to go. The export market is also a very big opportunity for them. So I think, if he can hold on for at least 12 to 18 months, I think then definitely this purchase which he has done will definitely not go in vain. He has to give in some more time because typically, to predict quarter on quarter performances is not an easy job, and I think it can be unpredictable. So I think keep a long term time frame in mind and continue to hold. Definitely good long term prospects continue. Alex, coming to the point of Mahindra and Mahindra, I think it is too over pessimism which is being played in the markets now. I think, as you rightly pointed out earlier in the show, they've got 30,000 bookings for their new electric vehicle, which is a kind of a sort of a record. And I think that clearly proves the point that the product is likely to be a blockbuster product for them. My sense is that these kind of dips have to be used by investors to actually accumulate such quality companies when such kind of panic comes in the market. I think fundamentals continue to remain strong. And as far as defense companies quarterly numbers are concerned, I think there is another company which went public recently, which is Unimec Aerospace. This company has also come out with a horrible set of numbers, and I think today the stock must be down. But that doesn't mean that the company is bad. I think one bad quarter obviously is a disappointing quarter, but obviously in the longer term, I think these businesses will do well. There are going to be lumpy performances, especially for defense companies, because execution and order book inflow, order execution, all that is not designed on a quarter on quarter basis. So I think investors who invest in such companies should realize that they have to invest for the longer term. They can't invest on a quarter or a short term basis. So this stock is trading X bonus, and I think the numbers which came out in the third quarter have been pretty solid. Very strong performances on the revenue, on the profit side, plus a very strong order book, which is expected to give the company good visibility over the next say 12 to 18 months. So I think for the time being till the market sentiment is down, I would presume that the stock would underperform. But if the investor has a 12 to 15-month kind of time frame, then I think it does not make sense to sell the stock in panic because fundamentals continue to remain strong. I expect that even the March quarter and FY26 to be equally strong. And, this earnings momentum will continue. And power transformers is a very large opportunity, with power generation getting more and more importance and government also pushing this sector. I would not be surprised that, continuously new orders could also come in. So I think just wait for some time. I think rather than panicking and, thinking that the stock has lost ground considerably, one is the bonus adjustment. And secondly, obviously, the selling has come from investors who have actually got in earlier. So just continue to hold for 12, 15 months. I think long-term prospects continue to be good. So I think if the investor has a 18-month kind of time frame, NTPC Green entered the capital market recently. I think it's a great business, a very strong kind of growth opportunity, and I think suddenly solar stocks have become slightly unfavorable in the current market situation. But if you see the business model and if you see the kind of capacity expansion this company is planning over the next 12, 18 months, I think definitely they should do well. First of all, they've got the parentage of NTPC, so there's a lot of financial and technical support from the parent. My sense is unless the investor has a long-term view, because these kind of stocks are not going to go up in a hurry. But yes, over the next 12 to 18 months, if he can hold on, he can definitely average at the current level. It could be a good bet for the longer term. I think clearly, the price at which the stock has been acquired, Alex, at 940. I don't remember when Chennai Petro was that high, but clearly, the price seems to be quite on the higher side, and that's probably one of the reasons the stock is given a maximum amount of loss for the investor. See, my sense is that unless the investor wants to take at least a 2-year kind of view, unless the investor is willing to wait for this kind of outperformance to happen only over the next 2 years, then only the investor should hold on. Otherwise, my sense is I think it's better to cut your loss and get into something else Simply, I mean, look at PSU banking stocks or typically private banking stocks, where at least the risk reward is in your favor. Because see, whenever you buy a stock, you have to obviously look at the risk reward and the kind of the risk which you are taking to get that upside. In case of the current investment, I think the buying price has been very very high, and to get that price, I think is going to take a long time. And I wouldn't advise the investor to even average at the current levels, because this is a commodity business and where margins are already going to be dictated by crude prices, the rupee movement, etc. So I think the best scenario is to get out and probably look at investing into some other stock like maybe a Bank of Baroda or maybe a Canara Bank, where I think the risk reward is in the favor of the investor. Think we also look at metals, with a little cautious stance as of now, because see, frankly, with the kind of tariffs announced by the US president, I think going forward, there are expectations that tariff war could increase, and that definitely could put a little bit of pressure on steel exports, specifically, aluminum exports. One good part for Hindalco specifically is that Novelis came out with very good numbers. So, they have a pretty good stance on that kind of positioning on the Novelis side. But if you look at the domestic market side, and most importantly, the outlook for margins, at least for the next couple of quarters, till the currency does not stabilize and till the tariffs are not very clear, I would say that there's no hurry for an investor to actually go and buy these stocks immediately. You could possibly see the stock remaining in a very close range at least till this coming September, and post September, obviously, as demand improves and obviously tariffs are more or less clear. At that point of time, one could think of accumulating the stock. There's no doubt that Hindalco is a great company with a very strong product franchise and a very strong cost optimized structure. But I think in the current scenario, going for metal companies would be a little risky. So it's better to wait and watch for some time. Model is very strong, and the growth opportunity over the longer term
Oh,
definitely is very attractive. But yes, in the short term, with these kind of numbers, valuations still appear to be quite expensive. So I think, if the investor has just a 1 year perspective in mind, then I think I don't think you're going to see a very strong kind of re-rating in the near term. Unless the investor has a really long-term view and can stay invested here for the next couple of years. See, because this business has been new, it was promoted with a lot of fanfare during the public issue time, but unfortunately, the company has not delivered on the numbers. So I think, despite having a very strong franchise, unless the market sees better earnings growth and better good quality performance numbers from the company, any short-term upside is not possible. So I would say that, rather than booking a loss, just keep a long-term time frame of at least, 12 to 18 months. 1 year could be a little short. So I think keep the faith alive and keep invested for a longer period of time. If you look at the longer time frame, SBI stock obviously went up very fast, and now the kind of valuation multiples which you are saying, I think clearly spells out the fact that if the time frame is at least 12 to 18 months, hopefully when this Indian economy takes off and the interest rates start coming down, the economy gets back into great numbers again. I think this is definitely going to favor the banking sector stocks, and SBI being a market leader, it enjoys one of the largest balance sheets and one of the best geographical spread out locations. So I think all this will get reflected into better valuations and better profit numbers in the next say 12 to 18 months. So I think the investor should not take a short term call, because I heard him saying that he bought the stock for the short term. See, SBI is not a stock where possibly you could now play in for the short term, because clearly the banking sector is depressed. We could see some improvements only from the April to June quarter. So I think you'll have to hold on for at least next 12 to 15 months to get a decent risk reward. So my suggestion is don't book a loss and wait for the next 12 to 15 months for the earnings to play out. Just at a very highly inflated level. And I think now in the very short term, looking at the kind of numbers which the company has presented, it looks very unlikely that at least in the very near term, at least next 6 to 12 months, any significant amount of re-rating is possible. Now, he mentioned that Reliance has taken a stake here, but I think unless the company generates a better earnings quality and generates a very strong earnings growth, it's unlikely that this fintech company could be re-rated. We have seen a lot of these fintech companies getting derated once market gets a sense that the margins are under pressure or the scalability is under threat. So I think it's a competitive business even for Justdial. So I think unless he gives a time frame of at least 12, 18 months, you're not going to see any major upside. And he was mentioning that he could switch over to something else. See, I think now within the telecom infra space, we feel that companies like Indus Towers, at around 335, 337, look pretty interesting. This company will generate a profit of almost 10,000 crores in the current year. and basically, is a very important component when you talk about 5G growth. So I think, looking at its market dominance and the kind of profit trajectory, here I think, valuations also seem to be quite reasonable. So, possibly if he wants to switch over and maybe book a partial loss in Just Dial, he can consider Indus Tower, because here I believe the telecom space is buzzing. And hopefully, I think next 12 to 15 months, you could see a lot of activity here. No, I think as the investor mentioned, this company is going to be merged with Coforge, and I think now going forward, market is looking at the consolidated entity, because whenever a merger is announced, I think it's the distribution swap ratio which is more important in the near term. My sense is that let the merger happen, Alex, and then I think one could take a consolidated view, because on a standalone basis, I think numbers have been pretty good. Markets have seen these numbers, but unfortunately, it's not got reflected in the numbers, because markets are now looking at the consolidated structure. And since Coforge reported a little disappointing set of numbers, we are seeing that the movement in Signity is also more or less static. So clearly wait for the time for this merger to get through. I think already the merger has been announced. So I think maybe in the next 6 months we could get better clarity on the consolidated entity. Overall, I think on a standalone basis, I think the company continues to do well. But going forward, since it's going to be a part of Coforge, the market would obviously attribute a valuation multiple based on the consolidated entity. So I think rather than buying the stocks now and adding your positions now, it's better for the consolidation process to get over and then take a call. No, I think Gobain has been a very old player in the float glass market, and I think it's got almost all the leading auto OEMs as its customers. I think what really keeps Gobain completely ahead is basically the kind of technology it gets from its collaborator. And I think the immense export opportunities. In fact, the company has been always saying that export market is a very large market, and going forward, the export market also be a very big opportunity for them. I think in the very near term, because the auto sector is going through a pretty, short-term kind of challenge in terms of the volume kind of softness, there could be a possibility that the company may underperform, for the near term, at least for the next couple of quarters. But longer term, if the investor wants to buy, I think 100 to 105 or 110 odd levels, what the stock is currently trading, he could take a 2-year view and stay invested. I think it's a good business, an MNC company, and most importantly has a very strong kind of export market potential. India, of course, is a very large opportunity for auto OEMs, and there are very few players, like Asahi India and Saint Gobain. These are probably the larger players operating in the float glass space. So I think to that extent he can stay invested, but keep a time frame of at least 2 years.